It's on the other side of this congestion zone that within, I think, about 3 monthly bars, you're going to see an enormous explosion in silver and a good strong move in gold, but silver especially. And also in the miners. The miners are doing better than gold, by the way. People doubt that, but you can measure it and it's a truth. And silver is now beating gold as well. Ever since November of last year, we had a breakout. Yeah, it's time to act. The congestion zone in the metals, I don't think is going to provide any more sharp sell-offs back into the 60s on silver. I think you're seeing this midpoint pullback here today. It's under 75. It's probably about as far as you're going to get. You turn back up on price to 90, and even the price guys are going to start to say, gosh, this is the 5th time pushing up to 90. Maybe this thing wants to go through. And when you get up and get 100 on silver again, not back to the 120, and you get gold back up, over 5,000 again, there's going to be a wake up that, hey, I thought this was supposed to go down, and it's not, And then, if all of a sudden the bond market is not improved, they've already been buying, according to Williams, New York Fed chair, at the president New York Fed. He said last November that the Fed was now going to start buying bonds, quote unquote. And his reason was, just to provide liquidity. Right. Yeah, it's to defend the bond market. So they knew the government bond market was not in good shape. Then we knew it too. But now it's technically gotten to the point where we're at the edge of the precipice. In fact, we think we've crossed the edge. And so you've had sharp weakening in price and bonds over the last couple of weeks, especially. And they're now challenging all the price chart lows you could find on TLT or T-bond futures or the high yields on the yield charts. And that's where suddenly investors, asset managers, governments who might be buying our bonds or less so, have to get concerned. And so that's when the Fed has to do something about that. And that means not raise rates, okay? So anyway, whatever. If they raise rates, that's fine. It just makes it worse. Then they get a worse crisis. So you can place your bet how you want. Our bet is they're about to engage in print through this or that tool. And that means more money flow, but money flow, if it doesn't go into bonds and doesn't go into the stock market, where's it going to go, okay? We know there's an answer.
A major focus of the conversation is silver's unusual price behavior. Despite repeated sharp declines, silver has consistently rebounded from major support levels. The analyst describes recent price collapses as bear traps, designed to shake out weak investors before a larger rally begins. Silver repeatedly tested resistance near $90, but refused to break lower for long. He argues that this long consolidation period is building pressure for a dramatic breakout. Once silver clears key resistance again, momentum buyers and institutional investors may rush back into the market. In his view, silver could rapidly enter a completely new pricing era, potentially reaching several $100s per ounce.
I think it could be very rapid. In fact, our assessment is that it will be very rapid. The issue is coming out of this congestion zone. And, everybody, every time silver drops, they pull their hair out, say, oh, it's terrible. Well, here's the situation. If you chop off that brief period of time where above 100, we get up to 120 in silver late January. It's like several days or so. And look at what's happened. In fact, the high weekly close for silver has been $100, just above 100. But if you take the action since late January through the present, so 6 weeks, you had the collapse January 31st and February 3rd, really a day and a half collapse that was most of the decline. Silver dropped to $66 by February 3rd. Okay. Look what happened since. Silver shot back over 90, came back down into the 70s, back over 90. And then with the war news, in fact, there were 2 or 3 punches up above 90 where they sold it repeatedly, 90, 90, 90, okay. Then the war news came, and we had sellers in gold and silver. And they sold silver off and gold enough to nip out the February obvious to everybody chart low. In silver, it was 66. So on March 23rd, after multiple sell-offs that didn't get back to that low, you finally had one that flushed it. We expected that. Several weeks before that flush, we put out a report arguing, especially that gold was going to take out its low that had occurred in early February. But don't believe it. It's a bear trap. once you do it. I mean, it's just going to do it and then go back up. Okay. Both metals went down on March 23rd and took out the February low. And no doubt there were so many sell stops that were hit by people who simply looked at the price chart and said, God, if we take out the Feb low, I'm gone. Okay. And so the number of sellers between $66 and $61 silver was no doubt enormous. It spent about 2 hours below that low. You can go to an hourly chart and see what I'm talking about. And within days, it vaulted $10 up off that low and ultimately went back to 90 again. And now we've pulled back. And where do we pull back to? Well, if you measure silver from that range, that plus 90 range, which most all the high recovery highs have occurred since that isolated peak. And you go back and look at the lows, it was 61, 60, 60, 66, 61. Okay. So in the mid to low 60s is your lower end. And the upper end of all the activity since the January 31st drop has been above 90. So you got like a 30 some dollar range there. Well, this pullback was about halfway into that range. The low today, just below 75. Now we're trading 77, 78. So we didn't even get back to the low end of the range. I don't think we're going to. I think that was it. Okay. We already argued that there's enough short to intermediate term technicals that say this particular rally since that March 23rd low is real, that you're coming up out of here this time. And we think that even though it got sold into again for the fourth time above 90, that $90 crowd is about to get blown out. Okay. This upturn we're seeing today from today's low, if it persists, and I think it will, you ever get back above 90 again, you're going to see something dramatic occur. You're going to start to see it moving back up to 100 and so forth. And people will then start to pull their hair out because I thought we're going to 50, It's on the other side of this congestion zone that within, I think, about 3 monthly bars, you're going to see an enormous explosion in silver and a good strong move in gold, but silver especially. And also in the miners. The miners are doing better than gold, by the way. People doubt that, but you can measure it and it's a truth. And silver is now beating gold as well. Ever since November of last year, we had a breakout saying that, okay, if you want to own gold or silver, silver's the one now. It's been a dog for 10 years. It was capped off against gold. It broke out in November, and that spread is still quite firm and has hardly flinched over the last several months. It's held its ground. I think I think it will go into that range, 300 to 500, and there are about half a dozen different reasons to argue that case.
Gold is presented not merely as a commodity, but as a form of real money, regaining importance during economic uncertainty. The analyst compares the current gold market to previous historic bull cycles, noting that earlier rallies produced gains of nearly 8 times from their lows. Applying similar historical patterns today could place gold far above current levels. However, he argues the present environment is even more extreme because of exploding government debt and weakening trust in fiat currencies. If investors begin losing confidence in bonds and central banks, gold may become a preferred store of wealth once again, especially for institutions seeking long-term stability.
I don't think we get a normal bull market in gold. This is not normal, okay? We have a potentially we have government bond markets, major governments. We're not talking, some country in Africa or some small country in Asia. We're talking about Japan. We're talking about the US. We know the UK is in trouble. You can't have this and it be, a passing thing. This is a massive glacial nuclear event in terms of market assets. And once the perception is that it's a so-so situation, and we know that, the chief investment officer of Chase, I think it was Chase, pardon me if I'm wrong, said 3 or 4 months ago that the 60-40 rule is no longer applicable. 60% bonds, 40% bond orthodoxy, allocation of assets. We now need to introduce gold into that. 20% that, 20% bonds, 60% stocks, which was a heck of an admission. And it probably should be weighted more. Here's what I think technically and fundamentally is going to happen. This next bull move in gold and silver, one, will take silver to a new reality. up at 3 to 500, let's say, maybe even beyond. And oh, sure, you'll have a sharp sell-off somewhere up there, but it ain't coming back to 50 again, okay? You might have a sharp sell-off, but you'll end up being in a new reality, like between $200 to $500, no longer 4 to 50 for 50 years, okay? And that new reality, and same with gold. And I pointed out before that gold, just to match the dimensions of its prior two bull markets, the one that peaked in 1980, the one that peaked in 2011. Higher highs, higher highs, higher. They were eightfold gains from bear low to bull high, bear low to bull high. If we go eightfold just to match those bull markets, gold would be $8,500. And that's merely doing what it did twice before. So sort of say, ho hum, gold did it again. Well, we've got a fundamental reality that is far different than then, okay? And so don't expect gold just to go to 8,000 again. I noticed that JP Morgan some months ago had a fundamental analysis and came up with 9,200 as a likely place for gold to go. Well, it's probably, yeah, it's going to go there, but it's probably going a lot further. But that was interesting on their part that they came up with a target that was sort of like that eightfold gain thing. The reality is that the financial stability of the Western world is in question because of the government spending. And this constant process of debt accumulation, and the bonds becoming effectively, pieces of paper. Well, that's what they are, okay? And if suddenly the investment public perceives them to be not the stability that they were, then good grief, it's 52 card pickup. Reality's changed. Institutions will be in question. Central banks will be in question. Fiat currencies will be in question, because they're reflections of that paper process. And when people undergo the pain that's associated with that regurgitation of unreality, all kinds of things change, including concepts and notions that are acceptable. So expect a new reality on the other side of this, one that entails the loss of confidence in the central banks. We may not have a Federal Reserve in 2 to 3 years, is my expectation, once we hit this crisis, because there'll be a perception that, hey, this game hasn't worked for 110, 15 years. It's been just repeated boom-bust cycles. Monetary expansion, stock market goes up, stock market crashes, et cetera, and they print more money. It's been a game, and it hasn't done any good because actually the stock market has not really made any money in terms of money growth, okay? So anyway, the answer is to that, expect this bull market to end up at much higher levels. Yeah, there could be sharp sell-offs after that, but they'll be in a different reality. But there'll also be an outside context that will change, such that the monetary metals are no longer viewed as, quote, precious metals to trade. They'll be viewed as money, which they've been for 3,000 years. I think the Chinese recognize that, based on what they've been doing for several years. So anyway, that's my answer to the question, what will happen on the other side of this? A new reality.
Beyond precious metals, the interview highlights a broader commodity resurgence already underway. Oil, grains, sugar, cotton, and industrial resources are quietly strengthening, while many investors remain distracted by stocks and technology markets. The analyst believes commodities remain historically undervalued compared to financial assets. He expects temporary pullbacks, especially in oil, but views them as buying opportunities rather than trend reversals. One key observation is that commodity indexes have already risen significantly without attracting major public excitement. Historically, large commodity bull markets often begin quietly before accelerating rapidly. If capital starts rotating out of bonds and overvalued equities, commodities could experience a prolonged global boom cycle.
Right now, I would stress grains. Oil I would buy, but I would wait for some kind of flush situation where we can tell that the chasers who, maybe their average entry price was 95 to 105 or something, it flushed them out, get down in the upper 80s or lower 80s, it's fine. It doesn't hurt the oil trend. The oil trend turned positive at 65 in January. You could have a sharp pullback into the 80s or something to flush out the chasers. And then resume the uptrend based on much broader fundamental factors that are in play here. The relative cheapness of oil as an asset measured against the stock market, measured against itself, measured against the commodity complex. Grains are another place to be. Sugar's languishing right now. Looks like it could turn up. Cotton just recently turned up. I mean, we analyze these each month with a monthly report where we go inside the complex, Bloomberg, and look at the segments. But there's basically it's almost a throw your dart situation. Buy the broad commodity complex in general, is a good bet. And come back in 2 years. And I think you'll be pleasantly surprised. And it's not volatile yet. And that's the beauty of it. In fact, the whole surge, the 30% surge in Bloomberg since last October, been no headlines, except for the oil component that started in March. But basically, you've had an asset category up like 30% and no headlines attached. And we love that. I mean, and there's no cheering, there's no fever. This is still a quiet, calm asset waking up. And other factors in play, like the breakdown in the bond market or the questioning of the stock market, will simply move more and more money into it. So that's a great place to be.
The conversation also explores the geopolitical dimension of precious metals accumulation. Countries such as BRICS members, and especially China, are increasingly building reserves of gold and other hard assets. According to the Analyst, nations that hold more tangible wealth may be better prepared for future economic instability. Unlike heavily indebted Western economies, some emerging markets have avoided the same degree of financial asset inflation. The speaker suggests the global balance of economic power could gradually shift toward countries emphasizing resource ownership, manufacturing, and commodity reserves. In a severe downturn, nations dependent on debt expansion may struggle more than countries accumulating real assets.
Well, they'll definitely be less victimized by the events, yeah. Because the more they've moved into money, gold and silver. I think the Indians are talking about silver as a currency or something, as backing the money unit. But these countries that have moved more so back into gold, real money, will be at a far better position of stability to weather a global depression. And I don't think we're headed for a recession, by the way. When we go down this time, it's going to be more like the normal metrics will say, well, this is a depression. We'll see. But the main thing is that who is less the victim of this downturn? And right now, the bubble U.S. stock market puts it into one of the worst positions of most stock markets in the world. Japan is a bubble market as well. But a lot of stock markets, even Europe, has not had the same kind of bubble gain since 2009 that we've had. Yeah, they're going to go down hard too. They're a part of a global economy. Even Shanghai Composite, even though it's only double and a half in gain since its 2009 low. And it's in a bull trend, but it's not a bubble. And therefore, yes, if it participates in a global downturn in stock assets and in the economy, sure, they're linked to the world economy, so they'll likely weaken too, but they don't have the bubble negativeness built into them in terms of even their stock market pricing. It's not a bubble. It can have a bear market, but it's not a bubble. So, and they're in a better place, and any country that has been accumulating gold more so than the Western world is in a far more stable position to weather this. Yeah, it's time to act. The congestion zone in the metals, I don't think is going to provide any more sharp sell-offs back into the 60s on silver. I think you're seeing this midpoint pullback here today. It's under 75. It's probably about as far as you're going to get. You turn back up on price to 90, and even the price guys are going to start to say, gosh, this is the fifth time pushing up to 90. Maybe this thing wants to go through. And when you get up and get 100 on silver again, not back to the 120, and you get gold back up at, over 5,000 again, there's going to be a wake up that, hey, I thought this was supposed to go down, and it's not, and then, if all of a sudden the bond market is not improved and is still perceived as shaky, and the stock market is questionable, well, where's the money going to go?